Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. We're back here on the Investor Coaching Show. Paul Winkler, along with Evan Barnard, talking money and investing. So, Evan, did you find out what you're looking for? Because I had the credit score myths was my thing. It was called Credit Score Myths on paulwinkler.com, and that was where I went through 10 credit score myths that you need to stop believing. Anyway, that's back in the archives. But anyway, what'd you find?
So, this morning, actually, I was looking through the journal, and this article jumped out. A fight over credit scores turns into all-out war. And so, the most common score, I won't read through the entire article. Anna Marie Andriatis and Gina Heeb wrote the article, just to give them credit here. But Fair Isaac is the name of the company that created the FICO score, okay? And they actually do a lot of other software stuff. They don't just do the credit score. They actually have other business tracks. I frankly wasn't aware of that. And what has happened in the past is Equifax, Experian, and TransUnion, the three big credit reporting agencies, basically were paying Fair Isaac a fee every time they got a score for somebody. Like the lenders would pay a fee, they'd get this data, and so forth. And for years, apparently, the fee was like, 28 cents or something like that. And so a few years ago, they had a new president at Fair Isaac, and he started figuring out, well, hey, if we charged 50 cents, well, hey, if we charged 75 cents. And so now it's up to like $3 or $4 or something like that, that if you call a lender, hey, I want to get pre-qualified for a house or whatever, they're paying $4 to FICO or Fair Isaac. And so the credit card companies started to figure out, or, the reporting agencies, Experian and so forth, they're trying to get into the business with their own Vantage score, which has been out there for a while, but it's not as accepted.
Yeah.
And, there's some lobbying going on to replace FICO with Vantage for like, FHA home loans, which is a huge piece of the market and so forth. Yeah. And so it just, if there's this niche and it becomes more profitable, kind of like when you talk about gold. If gold gets to 6,000 an ounce, everybody's going to be buying shovels, and all of a sudden there's going to be bunch more gold out there, and the price will drop.
That's right.
Competition works. And so it was just interesting, talking about the credit reporting and all, is capitalism is going to keep those things as efficient as possible. And so pretty soon it may impact all these things. Your car insurance, they sometimes pull credit, and all that kind of, it affects, of course, lending significantly. But it was just an interesting read that it's this innocuous little thing that we kind of know about, but I never really thought about, how does Fair Isaac make money?
Right.
So,
it is. It's and you go, okay, if there's no competition, then you've got problems on your hand.
Yeah.
And that's where it always ends up. You brought up gold. It was funny because I was going to find some stuff for the show today. And one of the things that I thought I would do is, I figured I'm going to pull up some audio. I was looking for audio on a specific thing. And I don't know if, Nick, if you got it ready where I can play you. You're cool. Okay, good deal. So I actually turned on the TV, and immediately, because I typically will watch like the financial channels, in the morning. I'll watch that and, just see what's going on in the financial world. Not necessarily to figure out investment strategy, like some people do. But it was more just to go, okay, what's going on in the financial world? What are these people? And I watch these commercials and I just go, oh, I gotta talk about that. But they had this thing on. It was a gold infomercial. That they were playing. And I just thought I'd play for the audience just this little thing, what they were saying, because it was interesting history on gold dating back to the Great Depression. So check this out.
They failed. You were wiped out. There was no FDIC insurance back then. Your money wasn't guaranteed. Could you imagine having your life savings, 20 years, 30 years of your life savings in the bank for safekeeping? That was your nest egg, folks. And imagine going to the bank the next day and the bank's shuttered closed. They failed.
So they basically have footage of the bank runs from the 1930s as he's showing this. So just to give you a little bit of context, what was going on.
And nice violins.
Yeah. Right. The spooky, Halloween-ish music, right?
You were wiped out, affecting hundreds of thousands of families, millions of families. So, a lot of citizens who had their life savings in banks that had not yet failed were understandably terrified that their bank would be next.
And I remember I worked for a huge insurance company. Mm-hmm. And the huge insurance company, here we are, 70 years later.
Right.
I guess it wasn't quite 70 years when I worked for the insurance company, 60 years later. Gosh, I'm old. No, I'm not. If everybody's out there, older people are going, shut up, Paul. You're only 61. But basically what happened was that they were talking about how they had bailed out the banks during the Great Depression. And they were, so you can depend on us. We've been around, and that was their whole shtick, was that we were safe, solid, and secure. And, the reality of it was that the banks did have some problems, and you didn't have the FDIC. You didn't have the safeguards that you have now. You go back to 2008 and Tim Geithner coming out and saying, the Treasury Secretary basically coming out and saying, we're going to make you whole if there's any kind of a problem like this. There was this whole idea that there is a backstop to the banking system didn't exist back then. So that's what happened here. But anyway, I'm going to keep going here.
And so they began pulling their money out of their bank and taking that paper money, which for all they knew could be next to worthless in 6 months or a year, and they began buying United States gold coins. After all.
So they took the money out of the bank.
Yep.
And they started buying gold coins. Okay, so you think, what are they trying to do?
Protect their purchase. Well, just keep from losing money.
Yeah, safety, protect themselves. We gotta buy gold. And what's interesting is what happened next.
Gold, throughout human history, across cultures, has always had a special value.
And as I talked about, the CNBC thing where they were kind of talking at the end of a segment saying that 4,500-year rate of return on gold, 0 after inflation,
right.
That little segment. But anyway, it's been a safeguard, quote unquote, and that's how it's marketed, as that. And those of you who hadn't heard me talk about that, its risk is super, super high. If you look at the standard deviation, the level of volatility, it's as high as the stock market, but return after inflation, nothing. You can buy the same basket of goods, as they said in that little segment, 4,500 years ago as you could buy right now with the same amount of gold. So, the reality of it is it safe is the question.
So you had all these citizens pulling their money out of banks, buying these gold coins, which created additional stress on our banking system. They had to put a stop on this run on the banks because that was just threatening more banks, more bank failures. And so on April 5th, 1933.
No, we did this to protect ourselves now, right? But on April 5th of 1933, what we did to protect ourselves,
Then President Franklin Roosevelt passed Executive Order 6102, which made owning over $100 worth of gold or gold bullion or gold certificates illegal.
Oops.
Yeah.
Oops.
And back then, gold was about $20 an ounce. So the maximum number of gold double eagles you could own were 5. And everyone would have to turn their gold coins into the Treasury for paper money on or before May 1st, 1933. And if you were caught with over $100 worth of gold, folks, it was enforced. You could face a $10,000 fine or 10 years imprisonment or both. And folks, they enforced it.
Yeah, they enforced it. And you listen to that commercial and say, well, what was the rate of return of gold from $20 to yesterday's closing price? What was the rate of return? And the answer was about 4.8%. Now, what was inflation over that period of time? So you do have a positive return above inflation, but it's only a little bit over 1%.
Yeah.
Yeah, is about it. Now, what if you took that same $20 and you put it in, because they didn't mention, they talked about banks. They didn't talk about stock markets or anything like that. And we talked about, stock market to protect against, help protect against inflation. If you take that same amount of money in large U.S. stocks, the lower performing of the asset categories here in U.S. stocks, that same $20 is about $864,000 versus gold's current price of about $4. And then you take the same, the same thing with small U.S. stocks. It's about 6.5 million. And you go, whoa, are you kidding me? No, it is the difference between, you look at the time value of money and you look at the compounding and you look at the difference between those things. And this is why, when it comes to investing, I want to protect myself against inflation. Now I can use treasury bills, because if you look at the rate of return of T-bills or fixed investments like treasuries, 5-year treasury notes or anything like that, you're looking at 0.5%, with treasury bills, because you're not going to get much return there, up to somewhere in the neighborhood of about 2% above inflation. Not much above inflation still, but it's not any different than we saw with gold, with a fraction of the volatility.
Yeah.
And then we use stocks to protect against inflation. And you say, well, and this is one of the things I see people doing right now, is buying a lot of mining companies.
Yeah.
And they think that that's how they're going to get around it. And you have mining companies right now, Evan, I don't know if you heard me talk about this, but you have mining companies right now that are selling for a multiple of earnings that is literally at what the tech stocks and the AI companies are selling for.
Yeah, the gold index, I think, I forget the number of years that I was looking at just last couple of days, was like 60% above the S&P or something like that.
Isn't that insane?
Yeah.
I mean, it's because, and it is a function of that.
That's a very short period of time, just to emphasize that.
Yeah.
Not for the last 50 years.
Yeah. And part of the reason for that is this whole idea of gold becoming kind of ubiquitous. I can go to Costco and buy gold, or, you have China driving up the price of gold because they've been hoarding it for their own reserves. They've been dumping treasuries for that particular reason, as I talked about last week. But, recognize that a lot of the things that we end up doing are emotionally driven. We make emotionally driven decisions, and they tend to be the things that really backfire on us and cause so much havoc as investors. So be aware that we are emotional beings. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right. We're back here on the Investor Coaching Show. Paul Winkler along with Evan Barnard. Okay, Evan, your turn. What you got?
Yeah. This is one of these conversations that is fraught with peril of someone wanting to take this information
and do something
and
with
start
it.
stock picking.
Irrational.
Okay. So that's not the point of this conversation.
Okay.
But it's an opinion piece by Charlie Garcia out of the Journal. Or actually, this is from MarketWatch. Sorry. And the smart money is done with crypto gambling.
Oh, finally?
Now they're betting on the dealers.
The smart money. I love that term.
So it says shares of crypto-friendly exchanges could soar if this little-known trade gains traction.
Oh, no.
And so the interesting thing, the article, it's, Coinbase has an enormous trade volume apparently.
Yes.
With all of this digital currency stuff.
Oh, yeah. People love gambling.
The article goes in to explain this thing called a perpetual futures contract, which apparently only exists. Well, I shouldn't say only exists, but I'd never heard of it before.
I've heard of it. I've never really researched it.
And I won't go into the intricacies of that, but in terms of these three primary exchanges, Robinhood, Coinbase, and I forget the other one, the Fed pays interest of 4% and change on a lot of these dollars that they kind of loaned out that the banks bought.
The arbitrage, how they make the product,
and they're collecting 1%.
Oh, the government loves it because it's a ready source of money to keep the
but
debt.
The Treasury's losing money hand over fist.
But they're making money in one way though. In what they're doing is they're because of some. You may not be talking about the same thing I am. I was thinking about stablecoin, where you have the issuance of stablecoin, and they have to buy treasuries in order to make the stablecoin, which gives them a source of money, which can help keep interest rates down. So maybe you're not talking about the same thing I am.
Because they talked about one of these traders has to have stablecoin.
Oh, okay.
For this arbitrage.
Yeah,
but it goes through the intricacies of this. But what really jumped out at me is towards the end of the article, some of the summaries of the outcomes of this. Selling shovels in the gold rush, a time-honored tradition. Most of you sensibly have zero interest in trading perpetual futures yourselves, but the infrastructure providers, the people running the casino, that's different. The house always wins.
That's right.
And it talks about scenarios of if the government has a stable coin, which company may win, and so forth. And what now? The question everyone's really asking. Coinbase shares up, et cetera, et cetera. The smart money has stopped betting on crypto prices, and we could debate for hours what smart money is.
Yeah, exactly.
Who
if they're smart
money?
or why, because they felt like they were hitting their head against a wall. Yeah, sure.
They've learned. Now they're betting on the plumbing. The boring, unglamorous infrastructure that keeps the casino running while everyone else is losing their shirts at the tables.
Yeah.
You want to know the secret to making money in markets? Don't be a gambler. Be the guy who owns the casino. Right. Better yet, be the guy who sells water systems to the casino so the toilets keep flushing while fortunes are won and lost upstairs.
Yeah. Well, it's a win Las Vegas. Steve Wynn would actually say, I don't care if you win at the slot machine.
That's right.
I just care that you keep playing.
Right.
Yeah, for sure.
And so it really is a good example of, okay, the market's efficient. You're not going to get ahead of this stuff. And you're better off, in this case, to me, owning the market rather than trying to find this particular trade.
Right. And people, we look at hindsight and we say, oh, wow, it would have been great to have owned Bitcoin. But, it was not obvious who the winner was going to be, in the race as far as cryptos go. And then the reality of it is you were betting on a bunch of zeros and ones, and you really just don't know. There are thousands of them out there.
Right.
And that's the issue. And then you had something about stock. It was something
Well,
you were talking about.
And kind of thinking about Bitcoin, this maybe
Speaking of which,
theoretically could tie. This is BDO's first brands audit painted a healthy picture months before collapse. And BDO Seidman's a huge accounting firm, and they had audited this.
This isn't Global Crossing?
It's something kind of
like
that.
It, doesn't it?
Before Arthur Anderson changed their name after
that's
Enron
right.
to Accenture or whatever. The first brands, I don't even know what they do, but it's an auto parts manufacturer.
Yeah.
Right, months after they signed off on their financials, it emerged that there was an accounting scandal that sent the company into bankruptcy and triggered a criminal investigation. And so, of course, BDO says our ethics say we can't comment on whatever ongoing litigation.
Right.
But it's just another, to me, that I always look at these articles and keep them handy for clients of, well, I know a lot about this company and I've worked there and, it's this. Well, you may think you know a lot about the company,
for sure.
And all of a sudden there's a scandal and the company goes bankrupt, and no one thinks about auto parts companies being risky, being some high flying thing.
Yeah.
bankruptcy is bankruptcy,
Oh, and the things that you don't know. I remember one friend of mine actually had invested, or he wanted to invest. Thankfully, he didn't, in a company, and he personally knew the CEO, the CFO. He knew the key players at the company, and they were like, "Oh, this company's great. You need to do it. This is going to be wonderful." And I said, "I don't care. Don't do it. Don't do it. Don't do it." And the company ended up going bankrupt. It literally ended up, and it reminds me of Charlie Ellis. When you deal with pensions, Charles Ellis. This is what he would say about this.
Even the most wonderful companies come and go. None of us would have known 20 years ago that AT&T would get into difficulty, or that Lucent, a derivative, would have real trouble, including the wonderfully talented people who are working at that company at senior levels. Very, very bright people would have missed completely Enron. Polaroid in the early 1960s was one of the greatest companies in the history of the world. We are very bright people. We do get the benefits of good public education. Many of us go on to graduate school. But we're not all that smart that we can see what might happen to really interesting companies in a very different environment.
Yeah, companies do come and go. And, the reality of it is that, the inventor of the cell phone, the inventor of the digital camera, a lot of stories that we can tell.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.